True Rate Mortgage Group, guys. I'm Tim Rhey, and I am here to talk about something that is something we all should know. How do banks make money? What's really going on behind the scenes? In the next 5 minutes, I'm going to explain to you how banks make money, and I'm going to share a couple things that I think could help you in your understanding. But more importantly, I'm going to share with you a way that you can save money on your next mortgage. And it starts with you understanding what's going on behind the scenes.
I never know what she's doing back there.
First things first, guys, how do banks make money? Well, banks make money off of you. When you go get a mortgage, they will give you a higher interest rate than the rate that they got. And that difference is how much money they make. They'll also charge you fees to do the loan. We know this much, I think. Yeah. But did you know that after your loan closes, your bank will take your mortgage and sell it to Fannie Mae or Freddie Mac? Fannie and Freddie are called GSEs, government-sponsored enterprises. They actually will buy the mortgage from the bank, give the bank a little bit of extra money so they'll make a little bit of a profit so that the bank can then go give another loan out. When mortgages are sold to Fannie and Freddie, they package them up into mortgage-backed securities, and these are then sold to investors throughout the world. These can be hedge funds, they can be insurance companies, they can be big banks, or the Fed itself can buy those. Now, if you'll recall, almost 3 years ago, the Fed was buying bonds heavily. That stimulated the market and made those prices go up. And because those bond yield prices went up so high, mortgage rates came down to historic lows. That's why everybody today has a 2 or a 3% interest rate on their mortgage, or at least most people do. But then what happened? The Fed stopped buying, and the value of those mortgage-backed securities just dropped. And when that price drops, the value drops, which means rates went up. What can the Fed do about that? Well, the Fed can jump in at any time and lower the Fed funds rate. Right now, the Fed has not done that much because of some other factors. This video is not about that. So how do loan officers make money? Let's say you go into a bank and you talk to a loan officer working at the bank. That loan officer is going to get a commission off of your loan when that loan sells. But here's the kicker. Some loan officers make more money and take a larger cut of that amount than others. Some lenders have to charge you more money because their commission is higher. So when you're shopping mortgage lenders, the real question that you should be asking, well, I don't know if you could ask this question, it may be kind of awkward, but the real question I think we have to ask ourselves is, well, what are your margins? Because there are loan officers who will do your loan for 1%. Now remember, every time a loan is sold to Fannie and Freddie, there's a dollar amount. There is a net collection. There's a profit. Of that profit, some of that has to go to pay for the loan officer. Well, if some loan officers have to make more money or have higher margins, that has to be accounted for. In order to account for higher margins, some banks have to give you a higher interest rate because the higher interest rate yields more profit. So if I'm a bank and I've got 30 loan officers and I'm paying them all, let's just say 2.5%. In order for me, the bank, to pay all my loan officers 2.5%, we've got to lock rates that are going to allow for more profit on that loan. Does that make sense? There's freedom and there's variation in the mortgage industry. Now, there are other loan officers who have better margins, who are willing to do your loan for, let's just say 1%. Well, if you're talking about a $500,000 loan, you're talking about 1.5%. You're talking about $7,500 less cost.
$7,500 less cost
to go with one loan officer for the same exact rate than another loan officer. So how do banks make money? Well, how do banks determine how much money they have to make? You as a consumer should always shop rates because every loan officer and every bank has a different setup. So when a bank gets a rate, they get the raw interest rate. From there to the rate you get is determined by the bank. They can set it any way they want. Now, obviously, if a bank is offering higher rates, then they're going to get less business, you would think, right? As a consumer, you have to think about this like a business. When you buy a home or when you refinance your home, you are a business. Your family is a business. You've got a profit and you've got a loss. You have bills going out every month. You have money coming in every month. It's important for you to look at yourself as a business. And when you get a mortgage, understand how that business works. You should understand how your money is being used, and you should certainly negotiate with that other business. Well, that's it for today's lesson, guys. I hope this makes sense to you. Please understand that there's a lot of stuff going on in the background when you get a mortgage. More importantly, understand that you have flexibility, you have freedom, you can negotiate rates, you can negotiate fees. That's how this business works. Your family business should negotiate with the bank business and get the best rate at the lowest cost. And trust me, it's out there. And if you want a quote from us at True Rate Mortgage Group, we're happy to help. We are named True Rate because we are dedicated to providing you full transparency and giving you the true rate, the true cost, and then giving you options to go with it. Have a great day, guys.